You know how in a game there's a referee who watches and makes sure everything is fair? Well, in the financial world, central banks such as the Federal Reserve, or in our case the RBI, is like the referee. They watch over the game of money and make important decisions that affect everyone. Now, what's interesting is that decisions taken by the US Federal Reserve also have an impact on us. Their decisions can influence our currency, the money that comes into our country from foreign investors, and more. And one of the things the central banks do is control something called interest rates. Now think of interest rates like the price of borrowing money. When they raise interest rates, it's like making it more expensive to borrow money to reduce the money supply in an economy, and when they lower them, it's like making it cheaper. Now global central banks, including the Federal Reserve, have been trying to tackle a problem called inflation. To fight inflation, the Federal Reserve has raised interest rates 11 times since it began tightening monetary policy back in March 2022. But in their last two FOMC meetings, including the one that just happened, they decided to keep interest rates unchanged around 5.25% to 5.5%, which is again a 22-year high. Now the new question for the Federal Reserve is how long they would keep rates high. Now let's look at some recent data on the US economy and inflation and the Fed chair's recent comments to see what the Fed might do next. Now in September, inflation rose 3.7%, which was lower than the peak of 9.1% in June 2022, but still significantly higher than the Fed's ideal target of 2%. Now while the inflation has been coming down, it's still running well above the 2% target. In the meeting that happened yesterday, the Fed chair said that while prices are coming down a bit, they're still too high for their liking. They want to see more good news before they're really happy. Now, even with high prices and the cost of borrowing money going up, people in the US are still spending a lot. Retail spending is doing well and the economy is growing pretty fast. In fact, US GDP went up by about 4.9% in the latest quarter. Plus, the unemployment rate is low at 3.8%. Overall, while inflation is showing signs of cooling down, there are still risks that could lead to price rises, especially with the recent spike in oil prices. Now, though the US economy has remained strong, the Fed has increased interest rate by a massive 525 basis points to a 22-year high, which is likely to weigh on economic activity, and the extent of these effects still remains uncertain. Now, hence, the Fed will see how the job and inflation data evolve between now and the next policy meeting in December and decide. So what do you think? Will the Fed strike again in the December meeting or will it hold steady? Let us know in the comment section. Having said that, this is me, Zana, signing off. Take care and stay invested.
Equity investments are subject to market risk. Read all investment-related documents carefully. Visit www.researchandranking.com